Welcome back to our channel, where we help you navigate the world of finance and make the most of your investments. In today's video, we will be discussing a topic that many of you have been asking about: how to make money with stocks, bonds, and mutual funds. These are popular investment options that can potentially generate significant returns over time. Whether you're a beginner or have some experience, this video will provide you with valuable insights and strategies to help you maximize your earning. So, let's dive in. Let's start with stocks, which are often considered the backbone of the financial markets. Investing in stocks means buying shares of ownership in a company. When the company performs well, the value of your shares increases, allowing you to make a profit. Here are a few key points to keep in mind when investing in stocks. Before investing in any stock, it's crucial to do your research. For example, let's say you're interested in the technology sector. You can analyze companies like Apple, Microsoft, or Google to assess their financial health, management team, and growth prospect. This information will help you make informed decisions and choose stocks with higher potential for growth. Diversifying your stock portfolio is a smart strategy to manage risk. Instead of investing all your money in a single company, consider spreading it across different industries and sectors. For instance, you can invest in technology, healthcare, consumer goods, and energy companies. This way, if one stock underperforms, the others may compensate for the loss. Stock market fluctuations are normal, and short-term volatility shouldn't deter you. It's essential to adopt a long-term mindset when investing in stocks. Over time, the stock market has historically shown an upward trend, offering significant returns to patient investors. For example, companies like Amazon and Netflix have delivered remarkable returns to investors who held their stocks for several years. Some stocks pay dividends, which are a portion of the company's profits distributed to shareholders. Dividend stocks can provide a steady income stream in addition to potential capital appreciation. Look for companies with a track record of consistent dividend payments. For instance, well-established companies like Coca-Cola and Procter & Gamble have a history of paying dividends to their shareholders. Now let's move on to bonds, which are often seen as a more conservative investment option compared to stocks. When you invest in bonds, you're essentially lending money to a government or a company in exchange for periodic interest payments and the return of the principal amount at maturity. Here's what you need to know about investing in bonds. There are different types of bonds available, including government bonds, corporate bonds, municipal bonds, and treasury bonds. Each type has its own risk and return profile. Government bonds are generally considered safer but offer lower yields, while corporate bonds carry a higher risk but can provide higher returns. For example, you can invest in U.S. Treasury bonds, which are backed by the U.S. government and are considered among the safest investments. Before investing in a bond, review its credit rating. Credit rating agencies assess the issuer's ability to repay the borrowed funds. Bonds with higher ratings are considered less risky, but may offer lower interest rates. Conversely, lower-rated bonds carry higher risk but offer higher potential returns. For instance, if you're comfortable with some level of risk, you may consider investing in corporate bonds issued by well-established companies with a strong credit rating. Bond laddering is a strategy that involves buying bonds with different maturity dates. By doing this, you can spread out the risk and have access to regular income. This strategy also provides flexibility, allowing you to reinvest the principal amount or take advantage of rising interest rates. For example, you can create a bond ladder by purchasing bonds with maturities of 1 year, 3 years, 5 years, and so on, ensuring a steady stream of income. Investing in bond mutual funds or exchange-traded funds can be a convenient option for diversifying your bond investments. These funds pool money from multiple investors to invest in a diversified portfolio of bonds. Bond funds offer professional management and can be a suitable choice for those seeking a hands-off approach. For instance, you can invest in the Vanguard Total Bond Market Index Fund, which provides broad exposure to the U.S. bond market. Finally, let's discuss mutual funds, which are investment vehicles that pool money from multiple investors to invest in a diversified portfolio of stocks, bonds, or other assets. Mutual funds offer several benefits and can be an excellent option for both beginners and experienced investors. Here's what you need to know about investing in mutual funds. There are various types of mutual funds available, such as equity funds, bond funds, index funds, and sector-specific funds. Each type has a different investment objective and risk profile. For example, if you're interested in investing in international stocks, you can consider a global equity fund or an international index fund. These funds provide exposure to companies outside your home country. One significant advantage of mutual funds is that they are managed by professional fund managers. These experts analyze market trends, conduct research, and make investment decisions on behalf of the fund. This can be beneficial, especially for investors who lack the time or expertise to manage their investments actively. For example, the Fidelity Contra Fund is managed by experienced professionals who aim to achieve long-term capital growth. Mutual funds offer instant diversification by investing in a wide range of assets. By spreading your investments across different companies, sectors, and even geographic regions, you can reduce the risk associated with individual investments. Diversification helps smooth out fluctuations and potentially enhance your returns. For instance, you can invest in a balanced fund that holds both stocks and bonds, providing a balanced approach to growth and income. When investing in mutual funds, it's essential to consider the expense ratio and any additional fees. The expense ratio represents the annual cost of managing the fund, expressed as a percentage of the total assets. Look for funds with lower expense ratios, as this can have a significant impact on your overall returns. For example, low-cost index funds like the Vanguard Total Stock Market Index Fund offer a cost-effective way to gain broad exposure to the stock market. Investing in stocks, bonds, and mutual funds can be an effective way to grow your wealth over time. Remember to conduct thorough research, diversify your portfolio, and maintain a long-term perspective. Stocks offer potential growth, while bonds provide stability and income. Mutual funds offer diversification and professional management. By combining these investment options, you can build a well-rounded portfolio that aligns with your financial goals. That's it for today's video. We hope you found this information helpful and insightful. If you enjoyed this video, don't forget to like, comment, and subscribe to our channel for more valuable content on finance and investing. As always, remember to consult with a financial advisor before making any investment decisions. Thank you for watching, and we'll see you in the next video.